Charlie, I'll start with you. The big theme this week, the great rotation.
Yes, it was a huge rotation, continued rotation. I think that the bond market has been the leader. It was a leader on the way down. Yields going down into August. Now they're leading on the way up. I do think very notable today. I mean, the stock market just kind of idled, sitting on the gains for the week and kind of cruised into the weekend. But it didn't get further lift with bond yields continuing to go out at the highs, right? The 10-year yield, 1.9. 10 days ago, it was 145. It's a massive move. It's a tremendous volatility. The banks peaked at 1 p.m. today. My point here is we got a great benefit from yields going up, but too much too fast just tells you that there's some urgency or instability in the market, and you don't necessarily get the benefit tick for tick after a while when you have this big overshoot.
Mike, if we do get the 25 basis point cut again next week, have you then seen the yield curve go back to something that everyone can just look at and the shape of it and say, okay, this is more constructive for the economy, for markets, and the Fed can then be a little bit less worried?
It's already done so across parts of the curve, right? So you're kind of back to where the 2-year is below the 10. I don't think it'd be decisive if just with another 25, because you still might be kind of flattish there. But I do think in general the questions about the Fed meeting are going to be significant, because you might get 25 and then you really don't know if they're going to signal that might be it for now or are going to ratify the market's continued expectation of more.
Liz, I mean, to Mike's point, U.S. Treasury yields in today's session, we're now at 4-week highs or higher. When you look at the moves here, do you expect that this is sustainable and we could continue to see rates move higher, or do you have a different assessment?
I think we can if the Fed does what we expect them to do, which is 2 more cuts this year. So we're expecting to see one in September and one later in the year, whether that's October or December. I don't know that it really matters at this point. So if they do it in September and then signal that they'll probably do another one, I think we can actually get ahead of this. A good phrase to use there is that the Fed is running out of time, not running out of bullets, but they need to use those bullets quickly. So I think there's a good chance that if they do it this year, we can turn it around and actually change the trend of growth and see a little bit of upward movement next year.
What did you make, Liz, of the retail sales data this morning?
I loved it. I mean, I think it's a great indicator. And everything that coming into the year, all of the positive news was built on a strong consumer, a continued strong labor market. So the fact that some of that data has stabilized and now actually surprised to the upside is definitely a good sign.
Michelle, I wanted to ask, because we now have a bull and a bear on the set for European equities. You're actually attracted to European equities.
I am. I think as a long-term investor, you have to be, simply because of lower valuations, and then the yield is so much higher. And let's face it, I eventually think investors are going to look at negative yields and move to the equity markets, because that's the only positive yielding place that they can get.
Liz, the other side of that argument?
I mean, I agree. I definitely agree that it makes more sense to own stocks than it does bonds at this yield. I think you want to make sure that you're still in the equity market. I don't know that I'm ready to say that this rally is sustainable and that it's time to really put a lot of risk on the table and go into cyclicals or go into high beta stocks. I'm not even really ready to say it's time to jump into small cap full speed. But I think if we see some of that come back, and if the Fed does what we want them to do and the yield curve normalizes in a steeper fashion, then yeah, I agree.
Bernstein publishing a list of 40 largest quality on sale stocks. This list includes names that have sold off in the short term due to controversial news or challenges, but still look like quality stocks long term. The list includes names such as Facebook, Disney, and Microsoft. Mike, is this part of the rotation, or are they trying to pick out individual names that they just like and their analysts like?
I think they're screening for stock. By the way, quality stocks, defensive stocks really were leading the way. They were the way to kind of stay protected from the overall turbulence. But with this recent rotation into more cyclical and value stocks, these have been coming in a little bit. And I think it's an opportunity to say, look, if you don't think the world has all of a sudden changed and the economy is going to reaccelerate and we have years and years to go on this economic expansion, these stocks are slightly more modestly valued than they had been, and they usually are kind of a good hiding place for capital if things are not looking too clear in the outlook.
Liz, what's your take on quality stocks? I mean, with something like big cap tech, even though they're under fire right now, more regulatory scrutiny, would that, I guess, constitutes quality for you?
I think the definition of quality in this environment is important. For some people, quality means that it's cheap and it's still a sustainable growth trajectory. For us, what quality would mean is strong free cash flows, a company that can pay a dividend and increase its dividend. We do like that larger cap space, which I know sounds kind of boring right now, but if you want to be in the equity market, I certainly would still be fully invested, but quality stocks are definitely the place to be. Valuations matter, But at this point, I think quality matters even more than valuations do.